Hello, ladies and gentlemen, and welcome back. Well, 2022 has marked many wild swings in markets, and we reached the pinnacle of another wild swing. At these decision points, we've seen upwards of negative 20% from markets recorded straight afterwards. We've also got what we call an engulfing candle, but it doesn't stop there because this is probably the biggest news events that we've seen during 2022. We have 4 central banks plus of interest rate decisional changes. We have the FOMC statement and meeting. And on top of that, we also have trillions of dollars of options expirations. So it doesn't get any bigger than this in 2022. And as we know, this is the week that should begin trends. So join us and let's talk about it all right now. Well, welcome back everybody to the Daily Show. We've got the macro data, the news, and of course the lead indicators for you, along with the key levels that you should be watching for stocks, commodities, and cryptos showing up in today's show. But let's begin by the Fed's message, because really this is the most important thing leading into 2023 as well. The Fed's saying that they're going to stay with rates very high for as long as possible. In fact, some time is their wording. Now, this is clashing with what the rates market is actually assuming. Remember, it's currently assumed that we're going to hit around 5%, 4.8 to 5%, and then cut throughout 2023 into 2024. At least that's what the bonds market's saying. The Fed's saying we'll keep it there for as long as possible. So who's correct? Well, probably the bonds market. And we'll talk more about that in today's show because it's such an important message. We have to understand this all together for 2023. Otherwise, you're going to be very lost in what's occurring and why markets will move the way they will. What about smart money versus dumb money? Well, we've seen a shift here that we really recorded a few weeks ago. And we basically were talking about the idea that as the market hits the trend line, which it has done, we were expecting weakness to come in. One of the reasons was because when dumb money crosses above smart money, it tends to be an inflection point for markets, at least during 2022 so far. It's happened again. We've now seen a switch back in some way. That hasn't usually meant the bottom is in though. What about some other negative signs before we go into some of the positives? Well, one of those has to be the MACD cross. We've seen this a few times here. Over here, we had a MACD cross. Over here, we had a MACD cross where it went from positive to negative, and that gave us some pretty hectic stats. In fact, when the S&P 500 crossed the MACD differential below the zero from overbought with a declining 200-day average, we end up getting some pretty scary stats. Only 25% of the time is the market bullish after 3 months. Now, of course, this is only one lead, but it is very interesting to stand out with. We also now have the time of year, we're in December, that we start to see every one of the central banks and everybody else talking about markets as a whole. And of course, that means that all of the analysts have come out, economists, and they're talking about what their expectations are here leading into 2023. So we've got here basically an expectation that if we go into a recession, the S&P 500 would theoretically trough at around 3150, which is negative 21% from the current levels. Now, this could happen during the start of 2023. It could happen during the end. It may not happen at all. Of course, it is a guess, but what is for sure is that almost all analysts are coming in with current valuations in the market being relatively fair. That is around that 17 times PE ratio or even forward PE ratio. I think this is going to be a very interesting statistic because I think whenever we've seen analysts come in around where they expect it to be, markets have generally returned worse, and that is something that we will be having a look at. What about conditional seasonality? Does that do anything for us in terms of this decline that we're currently seeing? Well, actually, during periods of weakness, that is bear market years, we usually see a fairly flat and not much of a Santa rally. You can see here we start off kind of hot and then we decline throughout December. Now, most of the time, what actually happens is we decline from the beginning of December all the way through to the middle. And it looks something like this one here, where we get this instant decline through December. We end up doing the options expiration, which is happening this week, the 3rd week options expiration. And then we get that final Christmas rally with the new year coming and then potentially weakness in Nasdaq. That's usually the way it's kind of worked in the past. Will it happen again? We're looking for the signs both ways. And of course, I think we're going to know where the bulls have full control of this market. And we'll talk a little bit more about that later on today's video. So what about average declines of bear markets? Well, we're in a bear market. We know that. We have seen a lot of recovery. The question then is, have we hit some of the averages of previous bear market kind of periods? Well, we never reached negative 28%, that's for sure. That would push us down into those kind of Goldman Sachs styles numbers, 3,200, 3,150, taking off everything that we put on since 2020 and then wiping all of that off. And a lot of bond analysts and other people that I've spoken to, that's their core belief. That's what they believe is the market is going to do, whether it's happening this year or it's happening in 2023. That's generally their target. We'll find out whether they're correct, but of course, it's always interesting to hear from those people. What about US dollars? It's been the best trade realistically of 2022, but it hasn't been in recent weeks. Well, we've seen this type of decline before from being really positive. It happened back in 2010. We saw the third quarter of 2010 be very similar in terms of decline. And what that led to was sideways market action for the US dollar moving forward. It probably has had its time in the sun. It's most likely now going to be relaxed as we see the Fed starting to potentially pivot and moving towards this idea of, okay, we're hitting terminal rate, now we're going to hold it there. So don't expect the US dollar, at least by statistics, to be the trade of 2023. It's saturated, everyone loves it. It's going to be more of a short, sharp kind of, okay, we're looking for direction. It's still one of the best, but it may not have as much upside as some people expect. It's getting near, or maybe even has hit the end of its pacing. What about the American consumer? One of the concerning things that we've seen is that 1/3 of the US economy is based on the American consumer. Usually you want to see a lot of spending in the economy. That helps growth. We're not seeing that as much, or we may not see that in the future, purely just due to savings. Have a look at some of these charts. US personal savings has now declined heavily, which is going to put a huge amount of pressure on inventories, as well as that US consumer credit year on year has hit its highest level since 2011. So people are spending, sure, but they're not spending with money they have. They're spending back on credit at now very high interest rates compared to where they were only a little while ago. We're also now seeing this come through to literally what's happening here with US manufacturing orders from China down 40% in unrelenting demand collapse. This is exactly what the Fed wants. This is what they planned. And of course, it is happening in front of our eyes. It's also represented in oil, which we've already talked many times before that we believed would collapse, and many people went against us on that one. But it is happening again on these charts. Now, if you want to know what happens when Feds tend to pivot, or when the Fed does pivot and start cutting rates, remember, they're not doing it out of the goodness of their heart. Come and follow us over at FX Evolution and make sure you join over there or follow us there, because we are sharing some charts such as this one. And what this shows us is that when the Fed actually rate cuts, they're usually doing so, and this is what the market's predicting right now, by the way, they're usually doing so because the economy is sick. Notice back in some of the other collapses in markets, what has happened and why the Fed has cut, yet we've seen the market bottom somewhere halfway or a third of the way through the cut. I think this is really, really important. Imagine if we start getting cuts and the market starts falling. The VIX goes above 45 plus, something like that. Do you have a plan in these scenarios? Let's just say that does happen. You have to have a plan. Be prepared for these situations and make sure that you have some kind of something that you can instigate with your favorite stocks, with your favorite investments, or whatever you're going to do during those times. Buffett says, of course, buy when there's blood in the streets, buy when there's fear in the streets. And stock markets really work on two things, greed and fear. So we've seen it before where we've had cuts, and usually part of the way through the cut, maybe around 1/3 or before the third of the cuts that end up occurring, we end up market bottoming off. What a statistic, very interesting. Make sure to follow along on Twitter if you're interested. Also, as part of our Christmas giveaway, we are giving away a bunch of our courses. It's free to enter. All you have to do is just go to links in the description down below. And of course, you just fill in literally your name and email address. First prize is the group mentoring with me. And then, of course, we've got a whole bunch of other courses there. There's only 1 day and 10 hours left as of the time of this recording. So make sure you get in. And why wouldn't you give it a shot? It's worthwhile. Let's move over now to what's happening in actual market rotations. What could they tell us about markets moving forward? Well, the first one is that the Dow has dropped less than the rest. And this is showing us, again, defensive style markets. The Dow's down 2.77%, the S&P 500 down 3.39%, but notice the Russell 2000 down 5%. Now, this is not historically a time when the Russell usually falters as much, but it has at the moment. 5% down shows us that there's not much conviction in the smaller based cap companies in the US. It's showing that they're concerned about debt. They're concerned about the pressures of high interest rate rises and the speed at which they're happening. Maybe the Fed won't be able to support the economy in time. And that's what the market's telling us. So what about what's underneath the hood? What's going on with the sectors in the market? Well, it's time for us to thank today's sponsor of the video, which is Tiger Brokers, and have a look at how sector rotation inside their platform could have helped us to gain edge over the last week. Well, what you might notice is that pharmacy, healthcare, utilities in general have been doing much better than some of the other markets. Now, what hasn't been doing well over the last 5 days is oil and gas, integrated oil and gas, and so many others. When we have a look at the industries, I think it makes sense to you. The last 20 days worth of movements have all been focused on the downward side for oil and gas, which we've been discussing because we saw it with the charts. And then, of course, also shipping. Remember that demand destruction play is now the most popular trade inside of the markets. If you move it to the percentage on the day, you'll notice that when we scroll up here, again, consumer discretionary, oil and gas, they were the best shorts on Friday because they were the best shorts for the last 5 days. The money flow has continued through. And you might ask, why is this occurring? Well, it has to do with how funds outperform the S&P 500. Remember, the 401ks out there in the world, the pension funds, and the super funds, depending on where you are in the world, all of these guys have to be invested at all times. Now, they cannot go into cash predominantly. They have to therefore go into defensive sectors when they feel like things are going poorly. And that's what they've been doing over the last 5 days. Of the main sectors, we've seen a huge shift towards more defensive style sectors, such as gas utilities. And we've seen things like paper products, water, that type of thing tends to be those main areas, healthcare, that markets move into. So if you're interested in finding out how to view markets a little bit better, it may be worthwhile checking out Tiger Brokers and the special offers that they have in the links down in the description below. And remember, there's so much more that they're upgrading about their platform all the time. And that's one of the things I like, being able to see the industries, the top 10 winners and losers, the different concepts that are working right now in terms of sector rotation, and of course, all the news available to you all the time on the platform. So check them out, look at their special offers, and of course, for Australian, New Zealand viewers out there, there's an extra special one for you, one free ANZ when you meet the T's and C's. Check them out. All right, well, let's just jump straight into the charts and talk about the VIX, the Volatility Index. As many of you would know, there's similarities with 2008-9. You've probably heard about it. We're going to talk about that, but I'm also looking at similarities here with the previous drop. This was the one that happened August the 15th, 2022. We saw a downward channel, broken. We've seen a downward channel, broken. Are they similar? Yes. Are they coming off the same level? Yes. So do we expect a VIX spike? Well, we kind of do, and we're, I guess, approaching this very cautiously, because as you go through and you look back in time for the VIX, most of the time when you've had a bear market, it's usually been blown off with a 45 plus VIX. That is, that fear has hit new premium highs. Everything's looked terrible. And that's when you usually see bottoms. Now, that tends to happen most of the time before or around those recessionary calls, because the market can bottom around those periods. But it really depends on what happens this week with inflation numbers and, of course, with the Fed. Will the Fed keep raising rates into bad inflation numbers? Are they worse? We just don't know that yet. If we look at 2008-9, the main comparison is that we never saw a really high VIX, and then all of a sudden we saw an extremely high VIX. And that's the similarity with 2022. Let's move over now to talk about yields. Well, yields have been rising a little bit here. The 2-year is gone to 4.34%. But we've looked at this so many times. Obviously, any longer time viewer will know that I've talked a lot about the US 2-year versus 10-year. But here's where I think things are going to get very interesting during 2023. And I think it's got to do with the US 3-month versus the 2-year. So that is the US 03MY, which you can plot on your charts, versus the US US02Y, which you can plot in your charts. You can put that in as a combo. And what you'll notice here is that we've got them kind of equaling. What's probably going to happen here is the 3-month, that is the Fed rate realistically, because the Federal Reserve is controlling the shortest rate the most, will have a differential with the US 2-year. Most likely the bond market will fight on this one. And what we'll see is we'll see the economy continue to get sicker, and we'll see that the bonds market is demanding many rate cuts. And this is expected to probably invert pretty heavily between the 3-month and the 2-year moving forward as we start to see the economic data, and we probably see some fractures around the world economically due to these high interest rate rises. Remember, if anyone said this to you at the start of 2021, that we'd be going back to interest rates at 5% federal rate, then no one would believe you. But that's where we are right now, and it's putting pressure on the economy. So expect this one to be one of the charts that we follow through 2023. And I wanted to share that with you. Make sure to subscribe as well, so that you can use that one to get a bit of a better understanding between what the market is telling you and what the Federal Reserve is actually doing. This is going to be a chart to watch. Let's talk about high yield bonds. So a lot of people are confused by this one. I have to bring it in. And they're wondering, how can high yield bonds be going up when the market's looking sick? Well, remember, all of the bonds are going up, and that's mostly because bonds are based also in the future rate cuts, and that's what we've been seeing. So if we go out to 2024, and I'll actually do that for you right now. So let's go to 2024. It looks like rates should be at 4.23% by basically March of 2024. Now, that's already many rate cuts into the markets. That means that the markets are probably sick, and this is what's expected. When we look at LQD, in comparison, LQD has performed much better. So this has actually been a very strong bond. Remember, all bonds are rising. They're rising because yields are going down, so they become more desirable, regardless of the risk that's on them. But what you will notice is that high yields have not risen as much. And this is because there's a sickness here. Would you rather take the junk bonds right now, or would you rather take treasuries and, of course, corporates, things that usually do okay, well, especially treasuries, during a crisis period? Well, the answer is treasuries. And that's why TLT has been performing the best of all of these, and why so many people are discussing it. The trade has probably started to go a little bit too hot, though. It's become a meme. Everyone's talking about it, and therefore it's going to most likely pull back. And I'd like to see treasuries come back down to this 100 level and then maybe stabilize a little bit. But I can see why people are entering into this. It's got good long-term ramifications as long as the Federal Reserve does cut in the future, which is the current expectation. Let's move over to the US dollar, get into some of these charts now. We've moved a lot of talking about the economy right now. Let's get down to what's happening this week. Well, the first one has to be the US dollar. We saw it go really low. Then, of course, it rose and it broke through this previous sell-off level, which was a drop, a base, and a drop level. We've seen that now hit twice, but the second time it actually broke above this level and closed. So it means that most likely the US dollar, at least temporarily, wants to go long. Let's have a look at the weekly close. Notice the two rejection wicks off very similar levels. The weekly close before, it then went down lower after opening and then wicked off that, showing us there is some demand here for the dollar index. Can it hold up? Well, we've got alerts at higher zones, which would probably be where you expect it to go to at the moment, which is around that 105, kind of 80, 90 zone. But I think this really correlates well with other markets such as gold. Gold came back to one of the most traded levels of the last 2 years. This level is serious, and it went down and then it rallied up and then it rejected. This is showing us that there's probably some weakness here in gold. There's weakness in a few of them. And at the time of this recording, it's actually broken below these two big rejection wicks that we got through last week during the Friday session and Thursday session. So this is a big deal. This is a current shift where we saw a higher high and we've seen a lower low. Even if we do rally now, we'd probably expect sellers to try to recommit and potentially gold to move back down to this 1767, 1770 zone to find out whether there's buyers recommitting at this level. But for now, it does look like gold has more weakness in it than strength, and the dollar is potentially a little bit stronger at this stage. What about oil? Well, it looks like it's set to potentially come down to our zone. 65 and 66 has been a level I've discussed what seems like eons, but it probably hasn't been that long. Yeah, so we were talking about it over here during March of 22, and of course during May of 22. I've been historically weak on oil, and the main reason was because I believe demand destruction would come through. Why? Because why am I going to bother fighting the Fed? The Fed's trying to do it anyway. So even with the Green Revolution or whatever else you wanted to come into the storyline, everyone was super bullish on it. It had the symptoms of a blow off top, and so far so good. Of course, first target 75 has been reached, and now we're looking towards weakness. So it does look like rallies should be sold off from oil. Of course, key levels here would be to actually see it break above these weekly highs if you were really thinking long on oil and that you want to position in those types of things. We saw weakness. We've now got a zone in here where if markets come back to something like an 80, you would still expect them to weaken. But if you're a long-term bull on oil, potentially you really like these levels down here between this 62 and 65 area. The reason is simple. This previous demand here was very strong. And we've also got a 200 weekly moving average sitting right on that. So a lot to like about oil maybe moving forward, but it's still weak for now. I think the consensus story is now becoming weakness in oil. That's kind of what you like if you want to start going bullish, but we haven't seen any signs yet. Still very, very weak here on the charts. Let's move over to Tesla. Now, there was good signs for Tesla players, and there's bad signs. This is not an easy level. The good signs are, look at this weekly, 2 rejections off a very similar level. It actually cleared the gap as well. That was that red area that we had, and we've been sitting there waiting for it for so long, that 170 to 173. Buyers showed recommitment. For real buyers to come in, we're going to need to clear 200. That's going to push in that trough, that peak, that higher trough, and then that higher peak. What you would see is a lightning bolt or the switch of trend. It hasn't happened yet. We're going to set an alert there for everybody so we can talk about it. Let's have a look at the weekly. So the weekly overall is not super horrible. Let's go to the daily again. Not a bad little shift here. We did go weak. We showed some horrible candles. Then we pivoted here with a long leg doji and we showed some bullishness. We find ourselves at roll reversal on the smaller time frames. Let's look at the 2 hour. You can see here the previous supports, the resistances, becoming the resistance again. And this is where, really this week in the data is going to play out. If the data looks good, we'll move up to 200 and everyone will feel great about the world. That could mean bad data, by the way. We actually don't know if good data is bad or bad data is good, unfortunately. But what we do know is that if inflation's out of control, still, expect these things to drop like a rock. This is a very pivotal area. We would expect buyers to show recommitment, but if it weakens and closes underneath here, I've spoken about it many times, I think the markets could go down to 136, 120 for Tesla. Let's move over to the options because as we know, and I said I'd do this, the options are super massive this week. And this is where we find ourselves as of Friday, 1.245 million units, 190 is the max pain. We're currently underneath that, showing that there could be a rally here. But let's look at the key put levels, 150 for the bottom end, and of course 220, 210, and 200. So really the market's going to be pretty happy if it closes between 150 and 200. Anywhere in there at the time of this recording would be A-OK, I'm pretty sure, with the market makers. Now, if the market ends up going further down past 150, you have to believe there's rallies to be bought during that time because most likely the market won't want to pay out these levels. And that's going to be consistent with what we see for the S&P 500 later. Very big options expiration. Tesla will be freed to do what it wishes to, most likely after this week. And the reason is because this options expiration frees both those sides. It'll make sense as we continue to do our videos throughout the rest of the week. What about Apple? We'll take a look at the options for that as well moving forward. We'll do that in the next video, so make sure you subscribe. This was a pretty crappy looking candle. Basically, it's another rejection wick, another lower high currently coming through. We know where the critical level is, which sits around this 134 zone. We'll set an alert for that. Should we make a new low? For day traders, they're going to be wanting to know if the market gets underneath that 140 to push through to those lows. And if we have a look at the weekly, again, another kind of, you wouldn't really say strong candle for either direction, but just a series of lower highs continuing to be the weakness point for the biggest stock in the world. XLY versus XLP, that's the consumer discretionary stock, shows a new low being formed during the Friday. Not good for the markets here. Again, just showing that weakness. And the one that we've talked about and called earlier, I think here, which was basically energy. We thought it was in distribution. It so far has been. It's weakening, and we're looking for it to probably reach around that 80. So oil stocks still continuing to slide, giving up some of their gains, which they deserve to give up. And we're coming back into a very nice structural point here. Hopefully it doesn't get too bad for people out there, but at this stage, maybe this 80 or even a lower level would coincide well with that 65 oil kind of level. Let's move over to financials, often considered the barometer for health in the economic state. And it came up and it made a new high. And this is actually symptomatic of so many sectors in the US and markets around the world. They all trapped in breakout buys. And you'll notice this doji here on the weekly. That's been met by sellers. So if this is a trap, they've done a good job. Why? Because they broke a new high. They trapped people into longs, no doubt around here, thinking they'd get breakouts, and they've forced a new low. So it's like a higher low, a higher high, and a lower low. You would think rallies now should be met by sell demand. At least that's what these charts are showing us. And there's weakness in the financials. That's not necessarily a great thing. If this starts to accelerate, watch out, because financials going down is not what you want if you're a longer term buyer. Just to prove the point, here's biotech. You'll notice again, no new lower low, but certainly a chart we're watching. Another one that we're watching is semiconductors, which is often considered the strongest part of America. And at this stage, it's in a holding pattern. So you want to have alerts underneath the low here, which will set price-wise about 212. If that occurs, again, probably points towards further weakness throughout markets. Let's move over to the DAX. We're at a critical zone again for markets, and this is what's happening ahead of this big news. Notice that the markets have not been able to break that 14.8 zone, and it just continuously hovers here. Is this an accumulation to a bust out, or, of course, a breach to the downside? We don't know yet. We would be looking at this saying it looks more weak than strong, but again, inflation numbers will probably change that as they come through. The US 2000, the small caps, they show weakness across the board. We've broken many good things here that people would have liked. We broke the trend line on the way up, so that's been taken out. We've got a double top style pattern here, which is weakness ensuing, and nothing much looks, very positive, I guess, on the chart side of markets here. What about the Nasdaq? Well, the Nasdaq's done another thing. It made a new low. It's hit this previous level of supply or resistance, and it's weakened off that many times, and it finds itself critical ahead of the big news, ahead of the central bank policies all this week. Move over to the S&P 500. We'll actually just use this one first. So we get that engulfing candle. That's, of course, a weakness signal on the weekly. You don't want to ignore those types of things. And if we go to the daily, again, it could be setting up for some kind of head and shoulders style event if it rallies here and then sells off, where weakness may come back through. That's something that certainly is playing. Now, if this is going to be accumulation, what most likely will Wall Street do? Well, they'll do usually one of two things. They'll either just buy it through here and push it higher, creating a double bottom, which is going to be hard to ignore, by the way, if it does breach through this 4,000 again, or they'll just take the low and do the same thing. So they'll take the low, instantly snap it into a buy. If we do end up getting a close below here, that's a close behind 3,900. I still think that this is the most key pivotal zone. That's where we had the last inflation number come out. That was 3750. And as you'll see in a second, the options sit at 3,800 as well. We have a lot of options sitting right on that level. So weakness and closes below here, closes, very importantly, will most likely ensue further weakness. And if we go down to the 2 hours, it's kind of playing the game that we semi-expected. That is, it came back into this zone here, which was the drop and the base and the drop. We then created bullishness. We then, of course, weakened, and we find ourselves at a catch-22. A new low probably means further lows coming, unless it instantly rejects it. If we get a new low and it starts to move up, we've got to consider, if we take this level out, that we're probably actually moving more bullish. We're open to both sides. We have to be. We actually don't even know how the market's going to interpret this news. But there's a great case to be made for probably the 3750 at this stage with the current available data that we have. Let's look at the options expiration. It's pretty wild. Of course, 380 and 420 being the standouts, 5.872 million units. It's not small, it's massive. And we know that Max Payne's sitting right where the market is right now, 391. That will change throughout the week. And it would be expected that we shouldn't be below 380 and we shouldn't be above 420 based on the options expiration at this stage. That's pretty wide, so it doesn't help us too much. But if we get closer and closer and closer to the 380, let's say we're at 375 at one point, you would have to think that that's going to be bought up to get it back above 380 by the close of the week. That's where the power of these options and understanding where they are becomes very, very important. If crypto is anything to go by, we've seen a fairly interesting looking potential distribution or maybe even accumulation. We got that break to the low, which made us bearish on Bitcoin on the short-term timeframes. If we get a new low, you have to think markets are going to drop, or at least Bitcoin will. So alerts this week setting for a new low, that would be very critical. And it looks like at this stage, that's the current consensus for this market. Weakness, weakness, weakness. Let's move over to the most important news moving forward, and it's massively stacked. Let's go through just the US news though. CPI and core CPI coming out 8:30 a.m. Tuesday, December the 13th. That's going to be massive. Then we scroll forward, FOMC statement funds rate press conference. Expectation is a 0.5 or 50 basis point rate hike. Will it be that? Probably. If it's 75, watch out. I don't think it will be. The Fed's already told us they're not going to do that, but we'll find out. And that's going to be a big event. Of course, Powell will try to reverse whatever's going on so that he can do the juggling act with the markets, I'm sure. But look at all these policies. We've got policies from CHF. We've got Eurozone. We've got everything coming out. It's a bonanza of data. Core retail sales coming out for the US. What's been happening in the economy? How bad's the demand destruction? Will the Fed have to pivot sooner? These are questions, along with PMI later on Friday this week, that hopefully we get answered. This is an absolute pivotal week. I cannot stress it enough. It is wild. There is a lot of action. There are trillions at stake, and I'm sure the manipulation engine will be out in force. Make sure to subscribe. Make sure to smash that like button if you enjoyed today's video. And of course, if you're interested in any of the special offers for sponsor of today's video, Tiger Brokers, check them out in the link down in the description down below, and make sure you enter the competition as well. Thanks so much. We'll see you in the next one. Bye for now.